Look, I think venture capital for 2017 is going to be a very interesting year. There have been a bunch of funds who have raised money, and I think although there is an unstable global outlook, there's no doubt that there are more technology companies that are growing into powerhouses, financial powerhouses of the future. So at Internet Deal Book, we track all sorts of M&A and investment activity across the world. And what we've found over the last year to the end of 2016 is that there have been significantly more deals, and actually the deal values have gone down a little bit. What that means is that there is opportunity for more people to participate in those deals, and part of the reason for the deal sizes getting smaller is that it's been cheaper now than in previous years to start a technology business. I think when investors are looking at making an investment in an early stage business, it's critical to look at three things. The first thing is the founding team. Are they strong? Does that founding team have a mix of business, of technical and domain experience? The second thing is, are those founders chasing a really large market? Is it a small domestic Australia only market, or is it Australia plus parts of the region or the whole globe? Obviously companies that are chasing larger markets are going to have a larger potential. Of course, the other thing to think about in chasing those markets is how big, how wide is a potential target market. If you're wanting to sell product or sell a service to people who have for AFL, well, you're probably only going to be limited to folks in Australia. Whereas if you're going to be selling something that is for lovers of tennis, your opportunity is much broader. And then the third thing is, what is the level of traction has that founding team made to date? Have they made sales? Have they been able to test the right price for their product? Have they been able to get letters of intent from particular customers? Have they been able to demonstrate that the product that they talk about actually works? They're the three big things we look at when we're assessing a company. And as for valuations, I think they vary, but if you've got a great team with a very large market and you're showing great potential through the traction that you're posting, well, of course your valuation is going to be higher than if you're on the opposite of those. One of the companies that we invested in 2 years ago is called GoFar. They are an IoT device manufacturer and Internet of Things manufacturer. So they have a device that sits on top of a car and it plugs into the onboard diagnostic port of a car, and it provides drivers real-time feedback of their driving habit, so they're able to adjust their driving and save up to 20% off their fuel bill. So not only are they saving money, they're helping the environment, and they're gathering really interesting information. Now, this interesting information about their driving habits could be very useful if they're on an insurance plan where they pay on a usage basis. So instead of everyone paying the same rate of insurance, if I drive more, shouldn't I pay more because I'm likely to have the chance of an accident because I'm on the road 20,000 kilometres of the year, as opposed to someone who only drives the car occasionally. When we got involved in this business, what we liked is that they had deep technology. Their deep technology was demonstrated in some prototypes that worked, and we invested a modest sum of money at what I considered a reasonable valuation. As time has gone by, the value of that company has more than doubled, tripled, because they've been able to secure larger contracts from organisations who want to buy many of these units to help their fleet of drivers improve the emissions as well as capture some of the driving habits.